I'd like to introduce Dr. Glick. Welcome to Bakersfield, and I'd like to invite you to come up and address our audience.
Thank you for the introduction, Dean Emery. This is not my usual look. This is my look when I come to speak to audiences in public. My usual look is how you're all dressed here, without a tie, without a suit. It's a pleasure to be here to speak to you. Let me start by saying, I'm from Northern California, from the Bay Area. Somewhere between Northern California and Southern California, there's this dividing line, I'm not sure exactly where it is, between the fans of the San Francisco Giants and the Los Angeles Dodgers. I think I'm far enough south in Bakersfield that I can probably presume that everyone here is a fan of the Dodgers. That's okay. But what I want to admit to you is this is my first time in Bakersfield. My wife's family is from Los Angeles. We've driven back and forth on I-5 many times from the Bay Area to Los Angeles. I've seen the exit from Bakersfield, but I've never taken it. This is my first time. I'm glad to be here. Better late than never. Now, Dean Emery hopefully has whetted your appetite for wanting to know more about, not 3 hours, it won't take 3 hours, but wanting to know more about monetary policy, what the Federal Reserve does. There's a lot of questions about monetary policy, and particularly why the Federal Reserve, my employer, has taken the actions it has. So I'd like to talk to you today about just that. What are the goals of monetary policy, how we've gotten to this point in economic history, and where we're going. And before I start, I need to give the usual Fed disclaimer in public that my remarks are my own alone. They don't necessarily reflect the views of others in the Federal Reserve System. So now I'm inoculated, I'm not going to say anything that I want. So let me start with the goals of monetary policy. Well, they're pretty simple to state. The goals of the Federal Reserve's monetary policy are full employment and price stability. Those goals, those words are set down in law by Congress. What's it mean in plain English? Well, in plain English, it means that there should be enough jobs for everyone, and your paycheck should hold its value. I mean, those are laudable goals that I think everyone can support. But in practice, there's a lot of confusion about how do we know what we've gotten there, and particularly about how monetary policy can be conducted to achieve those goals. And so we at the Fed have made a concerted effort to bring greater clarity and, I love this word, transparency to the discussion. And so I'm going to just list some of the specific policies the Fed's been doing the last couple of years to achieve those goals. Some of them are so-called unconventional policies, things we've not done in the past, and others are more conventional, things that we have done in the past and we're more accustomed to. So let me start with these so-called unconventional policy actions that you're probably more familiar with. Well, we've been engaged in what we call large-scale asset purchases, LSAPs. That's what we call it internally, but outside the office, it's more commonly known as quantitative easing, QE. That's one policy action we've been engaged in. In addition, we've increasingly used something called forward guidance. And that's just a fancy word to describe that we're trying to inform the public and the markets more clearly about our views of the economy and our intentions regarding not just current policy, but future policy, forward guidance. So you combine these asset purchases and forward guidance, they're unconventional policy tools, things that we had to do given the situation for reasons I'll describe in a moment, with our conventional policy tool, which is manipulating short-term interest rates, which are basically near zero. Those policies together have been the basis of the Fed's efforts to get people back to work and to keep inflation low and stable. Now, we started these policies several years ago, basically 5 years ago in 2008, after the country had essentially suffered the worst financial crisis and recession since the Great Depression back in the 1930s. The Federal Open Market Committee, the FOMC, that's the Federal Reserve's main monetary policy body, at the time, 2008, cut the federal funds rate, that's our short-term policy rate that we have direct influence over, we cut it basically to zero in the fall of 2008. We would have liked to cut the rates even more because the economy was that severe situation. But you really can't cut nominal interest rates much below zero. So we reached the limit of what we could do with conventional monetary policy, controlling short-term interest rates. So the Fed introduced these unconventional, these alternative ways to ease financial conditions in order to achieve our goals, to stimulate economic growth and job creation. And that took the form of the asset purchases, quantitative easing, and forward guidance. So those are our goals and the tools that we've been using to try to pursue them. Now, come to realize, when you talk to people in public, that there's kind of a lack of understanding of the connection between what the Fed is doing in terms of the policies just described and what it's trying to do, create jobs, and while at the same time maintaining price stability. It's not always clear what that connection is. I mean, someone asked me, asked my colleagues, I understand the Fed's lowering interest rates, and I understand that may get some people, because they have a cheaper car loan, to buy a car, which they otherwise might not do, but why does that create jobs? Why does that reduce unemployment? How does that work? So, as I said, I realize people don't always make the connection between the lower interest rates, that they buy more cars, and then other things that happen in consequence to that. So people buy more cars, we're obviously creating more jobs for car manufacturers. And if you're buying more cars, those companies have to hire more people at some point to make the cars. They also got to hire people to market and sell the cars. And with more workers on the assembly line and in the marketing and sales departments, they need more people in the HR department. They need more people in accounting, particularly from your local institution. They need more people running the offices. So now you got all these newly employed auto workers and marketing people and accountants. They've got more money in their pockets, and they're doing things they couldn't do before with that money. They can go out to restaurants, and the restaurants have to hire more wait staff to serve more customers, and they have to order more food from their suppliers. Or maybe the people spend their money to go to the movies, or maybe they even buy more cars. So that's what economists call the multiplier effect. You start with something, like the Fed lowering interest rates, and it introduces one person to do something, introduces other people to do something, and over time, you have a large impact. So those are the goals of monetary policy: full employment, price stability, the mechanism through which monetary policy gets you from here to there. But there's still a question about why do we need so much monetary stimulus to continue? We're still got interest rates near zero. We're still buying up all these assets. We're still telling people we want interest rates to stay low for the foreseeable future. Why do we need that much stimulus in the economy? And to answer that, you've got to turn to understand the circumstances that have brought us to where we are and why the economic recovery, we are in recovery, but it hasn't been as strong as we would like. So why hasn't the recovery been as strong as we'd like? Well, there are multiple factors that caused the financial crisis from which we're recovering. And I'll go into those in a second. And there are also multiple factors that are headwinds, drags to the recovery as we proceed. And I'll enumerate those as well. So as I said, the crisis is basically 5 years ago, 2008. I don't know how many of you remember September 2008. You had the 5th anniversary of the collapse of Lehman Brothers. Important financial institution. That led to a lot of, this is now the 5th anniversary, there's a lot of commentary, if you read, various newspapers and periodicals, reflecting on the crisis. What did we learn? Have we learned anything? And that's another 3-hour lecture. So it's good to reflect, because, time and distance dulls people's memories, and it also lets people oversimplify the causes. Everybody think, there was, some people ought to go to jail, or bad policies, bad luck. I mean, it's a combination of, they have a simplified understanding of what the causes were. but let me give you a more broader brush as an economist. Economists always have on the one hand, the other hand. I mean, there's always that joke about, Harry Truman, president, at the end of World War II and in the early 50s. It was under him that what's called the Council of Economic Advisors was established, where you'd have on staff economists come and give them advice. But the person would come in, the economist would come in and say, Mr. President, on the one hand, blah, 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 blah. And then, on the other hand, blah, 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 blah. And Truman is supposed to have said, can anyone find me, please, a one-armed economist? So the situation is actually complicated, and I'll give you, enumerate some of the factors that explain, where we're coming from. Because it's easy to forget how bad it was, and how many things came together in what, in a sense, was a perfect storm that led to the crisis and the recession of 2008, 2009. So let's start before then. Go back to the early 2000s. At that time, we were recovering from the dot-com crash. The housing market has just started to take off. That's great. Provided a much-needed boost to the economy, 2001, 2002, 2003. As house prices rose, people felt wealthier. They started to spend more. Again, that's great. And then buyers flooded into the housing market. Everyone was sure that housing prices would continue to rise. That's not so great. Everyone expected housing prices to keep on rising without end. I mean, for one, it made lenders feel comfortable taking risks. I can lend to someone. Eventually, the house that I'm letting them buy will rise in value. They'll have more equity they can use to kind of pay off the mortgage payments they owe to me. And it also meant that people who didn't actually have the income to make monthly payments could get a mortgage. But that didn't matter because housing prices kept on rising. You could always reduce your payments by kind of buying back sort of your, reducing your mortgage balance out of your equities, in theory. And all of a sudden you had people who put little or no money down, were sitting on 5- and 6-digit figures of home equity, which could easily convert into cash to buy SUVs or home entertainment systems or any number of things that had once been luxuries that now seem within reach. And at the same time, you had these very complicated financial instruments, CDOs, collateralized debt obligations, and CDOs squared. They got more complicated, and to be truthful, the regulation was lax. There was little or none of it. Things got more complicated. And then you had all these high returns to the lenders, the middlemen, the financial middlemen involved in creating these instruments. They didn't really care about the exposure to risk as much as they might, in hindsight, think they should have, because they didn't feel the direct effects. They could pass on the risks of something to someone down the line, and they still got their short-term gain by originating the mortgage to begin with, for example, or packaging it and then sending it on to someone else. And so the mortgages became far more generous. They became easier to get. The risks increased, and that risk was kind of chopped up, put into a blender, repackaged and sold on and on and on. Sometimes to investors in other countries, spanning the globe. So it reached the point that people who owned the risk often had no clue what they had. So that's where we were at in 2006, 2007, and then the bottom fell out. Lo and behold, housing prices, which were sustaining all this stuff, didn't continue to rise. They started leveling off. People fell behind on their mortgage payments. Housing values plummeted. Credit dried up. You had financial institutions that stopped lending, not just to consumers, to businesses. They stopped lending to each other. That choked off funds that firms and small businesses needed to finance their day-to-day operations. So you think back to 2008, Fannie and Freddie Mae, major quasi-government institutions involved in mortgage lending, they became insolvent. Lehman Brothers failed, as I mentioned. Washington Mutual, AIG, big insurance company, which had all kinds of connections and ways that weren't clear, not just through the insurance market, through other parts of the financial system. It went into insolvency. It seemed at the time, very possible that the whole financial system was going to collapse entirely. And the resulting fear and panic could have easily ushered in a major depression. Now, I want to stress, though, as bad as it was, and I think people who are that young that everyone has some memory, it could have been much worse. Right? Yes, unemployment went up. People lost their jobs. housing values plummeted. It could have been much worse, because historically, that's what's happened when you have widespread financial panics of the sort which was beginning to emerge in 2008, cut off the flow of credit. That's the lifeblood of economies, people borrowing and lending to each other. But that didn't happen. And in part, that's because, and I appreciate Dean Emery's acknowledgement of that the Fed did something very important at the time. The Fed moved quickly and decisively to safeguard the financial system. Now, I'm biased. I would give the Fed a very high grade for the actions we took. To show I'm not totally biased, I'd probably give us a lower grade for our ability to explain and build support for what we did. We set up a whole bunch of emergency support programs to bolster, the money market funds, to the government securities market, whatever. And because we didn't do such a good job explaining things, what you had happen was you had millions of Americans who were losing their jobs and their homes, and it seemed as if the Federal Reserve was more concerned about saving financial institutions than on saving jobs. But the point I want to emphasize is that a collapsed financial system would have taken whatever the remaining finances of the average American household along with it. It would have resulted in a much worse situation with much more unemployment and an economy of catastrophic proportions on a par with the Great Depression. Great Depression, unemployment rose to about 25%. And not to say that it didn't get high here, it rose at the peak to maybe about 11%, right? It's bad enough, but it could have been a lot worse. But I think that message, what the Fed did to avert that worse outcome, because it's always hard to justify something that you don't see happen. It's like what's called a counterfactual. If the Fed hadn't done stuff, we would have happened, and that's what we believe had happened, and that's what we use to justify what we did. That message got drowned out, and I think that created some misinformation. It's created some confusion. I think a lot of people thought that we launched all these secret programs that put taxpayer money at big risk, and we gave financial institutions below market interest rates. And to be clear, that was not the case. Our lending programs were always publicly announced. They're regularly reported on. The lending was backed by good collateral. Nearly every penny has been repaid with interest. In fact, the Federal Reserve's emergency lending programs, is the whole alphabet soup list of names of these programs, 2008, 2009. They've almost all been unwound. They generated on net about $20 billion worth of income that the Fed turns over as it's required by law to the Treasury. And the borrowers from the Fed, they did not get below market interest rates. In fact, most of the programs charged penalty rates. We wanted borrowers to go back to the private markets as soon as the markets opened up again. So that's what we did at the height of the crisis. Could have been a lot worse. So that brings us to what happened after the crisis, the recovery. It's a legitimate question to ask. Why aren't we further along in getting everyone back to work? The latest statistics, I guess October came out last Friday. It's still questions about the underlying trends. With unemployment was 7.3%. So at its peak, unemployment was 11%. It's now down to 7.3. I will hold for questions the whole issue about, well, a lot of people have left the labor force, because they don't have hopes of finding a job. That's one reason why the unemployment rates are to improve. But by almost any measure, things have improved, but they haven't improved as quickly and as much as we would like. And the question is why? Well, just as I've argued, the crisis was a perfect storm. It involved multiple factors coming together to make everything so devastating. There's a number of multiple factors also that have come together to hinder the recovery. Headwinds that the economy has had to face that has slowed growth from what it otherwise would have been. And there's a couple of them. I'll enumerate them and then I'll go into more detail. First of all, the financial crisis itself destroyed trillions of dollars of household wealth. Secondly, the financial crisis left the housing market in basically a deep depression. Thirdly, the financial crisis made credit hard to get. And fourthly, the federal government's more recent austerity is exerting a huge drag on economic growth. And fifthly, all these factors kind of came together to create tremendous uncertainty. Those are all drags, hindrances to the recovery process. And so let me go into more detail about each of these items. So first, the collapse in housing prices caused about $6.5 trillion decline in US household wealth. On top of that, the stock market plummeted, causing roughly another $6 trillion, not billion, trillion dollars in lost wealth. People got scared. People saving retirement, saving for college, got scared. They scaled back their purchases, and consumer spending declined sharply. Now, since then, we've seen the stock market recover quite well. I think it's exceeded the previous peak. But the housing market is not. You still have millions of people who are underwater in their mortgages. They owe more in their mortgages than their house is worth. So that's an ongoing hindrance to the recovery. Second factor. Well, it's a fact that past recoveries have generally gotten a push from home construction and spending on household goods. When the economy starts to recover, it's the housing sector where people start spending more money, and that's kind of helps propel the rest of the economy. But this recession, the one we're recovering from, as I mentioned, was caused in large part by a burst housing bubble. So it meant the usual source of a jump start was still mired in these brutal conditions. Now, only in the last year have you seen an upward turn nationally in the construction market. And obviously it varies across markets. It's what goes on in Kern County, about the same thing happens in San Francisco, whatever. But nationally, the indications were, from bottom, we hit bottom maybe a year ago. Housing prices are beginning to rise, and construction is arson to rise too. We can talk of how strong that upward jump or trend is in the housing sector, but we're certainly working in the right direction. Right? So you have these two factors I've mentioned: the loss of wealth and the housing weakness. They're tied to a third factor: tight credit. So unless people have perfect credit, it seems like almost no one can get a loan. I'm assuming everyone in this room has perfect credit, right? So small businesses are particularly hard hit. For one, real estate's become less viable as a collateral with lenders. And for another, certainly at the immediate months after the crisis ended, many banks themselves were too weak to extend much credit. Now, since then, arguably, credit conditions have improved, but it's my understanding that small businesses in particular still face, a challenging environment to get loans. And so, on balance, credit is still sort of a hurdle, a headwind that the economy is dealing with. The fourth factor restraining growth today is federal fiscal policy. So this year, income taxes were raised on upper income Americans, and the Social Security payroll tax it was allowed to, there was a tax cut that was allowed to expire. So it went up 2 percentage points also in January. So that ate into people's disposable income. If you're a high income person, you're paying more taxes, and then the regular people paying Social Security taxes, those taxes cut up to your disposable income as well. And then otherwise, that money could have gone to consumer spending. And on top of that, we have budget austerity, that kicked in earlier in the year, at least in the way Congress did or did not agree about future spending cuts. And all of this, the direct near-term result is that higher taxes, less spending by the government had a direct negative contribution to GDP growth. And there are estimates about how big that contribution is, and some estimates are that federal fiscal policy, these changes I talk about this year, is subtracting roughly 1.5 percentage points from economic growth. So the most recent figure that came out for the third quarter, was 2.8%. It was maybe basically 2.5% the last 2 quarters we have data. So without this fiscal drag, some people estimate it would have been 1.5 percentage points higher. It would have been near 4%. Okay. Now we can debate, there are reasons why, the taxes were raised and spending is cut. There's concern about the long-run budget situation of the federal government. And it's never clear when, if you're worried about the long-run budget situation, when you should make the adjustments to raise taxes and with some combination of lower spending. But it's suitably to the case that the changes we've seen now, whether you accept the rationale for them or not, have had a negative direct effect on GDP growth. We could talk about fiscal policy also in another 3-hour lecture. Okay. So I mentioned 4 things. Loss of wealth, the housing market collapse, tight credit, and then fiscal policy acting as drags on growth. And monetary policy can chip away at some of these factors. We see where the economy is going. We can put our foot a little bit more on the accelerator to try to offset those things. But there's something else that we can't control, and that's uncertainty. You've got business leaders, are nervous about tax and regulatory policies. You've got households that are worried about their jobs and future income. And everyone's uncertain about Washington's ability to overcome gridlock, including many politicians who live in Washington. None of that's bolstering anyone's confidence. So that's another thing, a backdrop to the environment that making things a little bit harder to get the economy going more strongly. But then I want to emphasize, despite these multiple headwinds, these hurdles, the past 4 years have seen the U.S. economy grow. Slowly, to be sure, but it's growing, and we're definitely making progress towards the goals of more jobs. So job growth in particular, it's been fairly steady and positive. The most recent numbers came out, like I said, on Friday for October. It's a little bit hard to interpret them because of the effects of the federal government shutdown in the first part of October, but they actually surprised people on the upside. So for October, the data said that despite the shutdown of the federal government in the first part of October, the U.S. economy added roughly 200,000 jobs in October. It's added roughly 2.3 million jobs over the last 12 months, roughly 200,000 jobs a month. So that's clearly evidence of continued improvement in the job markets. We'd like to have seen more. Historically, you sometimes see months of where 300,000 jobs are added, even more than that. But the reasons I gave you just before are reasons why we're not seeing that. So moving in the right direction, just slower than we would like. Now, I don't intend to kind of give you much in the way of forecasts here, but there's staff at the Federal Reserve Bank of San Francisco and most other people who are in this business. We see continued improvement. So unemployment right now is 7.3%. We expect gains in jobs to continue. Obviously, it's going to vary by locale. So again, Kern County is different from the Bay Area versus Los Angeles. But on a national level, we continue to see steady growth in jobs. And unemployment is going to edge down gradually. So it's 7.3% now. And give you numbers, maybe 6.75% at the end of next year, 2014, dip into the 6% range in 2015. So that's what's happening on the employment side, one of the targets of Fed policy. To repeat, we see recovery, it's slow, but it's ongoing. Now turning to inflation, I'll be much briefer there. Different measures of inflation. There's what we call headline inflation, includes prices of everything. There's also what we call core inflation. We subtract out what we call the more volatile items, which kind of create a lot of noise, and that includes agriculture, I know. But both of those measures, headline or core, but inflation has stayed low and stable. Let me repeat that. Inflation is low and stable. It may seem surprising to you who have heard that the Fed's easy monetary policy is leading us to high inflation, and in fact, we no evidence of it yet. Since the start of the recession in December 2007 till now, the inflation rate, the overall inflation rate, has averaged 1.5% per year. And that's below our 2% longer run target. Now that doesn't mean that the individual prices of particular goods and services don't change. The price of gasoline, for example, fluctuates a lot because it depends on the price of oil. And oil is a global commodity. It may be coming out of the ground, or shale or other sources in California or South Dakota, whatever. But it's a global commodity, and its price is influeed by a myriad of market factors beyond our control. But while the prices of some goods are rising, prices of other goods generally are going to be falling. And that's why we look at the inflation, the change in the prices of a range of goods. And by that measure, I'm emphasizing general inflation has been quite sustained and quite reasonable. Now, where do I see inflation going in the future? I mean, over the past year, the Fed's preferred measure of inflation has been roughly even lower than that average I gave since 2007. The last year, inflation's risen about 1.25%. So as the economy continues to improve and unemployment returns to more normal levels, we expect inflation to gradually rise a little bit more in the next few years from the 1.25% it is now towards our long-run target of 2%. Okay. So we're making progress on employment, and inflation is below target, and we don't see it kind of jumping up to a level that we were concerned about. So let me kind of wrap up and talk about where we're headed in terms of monetary policy. The economy is improving. Monetary policy is continuing to provide stimulus. We still got the interest rates near zero. We're still doing these asset purchases. We're still telling markets through forward guidance that we're going to keep interest rates low for a while. But that's not going to be the case forever. Right? We expect economic growth to pick up somewhat next year. I mean, third quarter this year was pretty good, but there's some reasons in the fourth quarter, that's October, November, December, it'll be a little bit weaker because of the effects of the federal shutdown. But next year, we expect growth to kind of continue it'll still be positive, but to be stronger than what we've seen in the last quarter or two. So as the economy improves, the highly accommodative stance of monetary policy that we're pursuing now, it's not going to be needed. So we're going to gradually adjust back to quote-unquote normal. And the first step is going to be slowing the pace of asset purchases over time. So if you've maybe read the press, the Fed's buying $85 billion of assets, both either treasury bills or mortgage-backed securities each month. In September, there was a big thing where the markets expected the Fed to dial back a little bit at the times, not by $85 billion, maybe by $75 billion, maybe by even less. The Fed didn't do that, and for reasons that the Fed, gave at the time, that circumstances didn't warrant it. But eventually, there will come a time when the Fed will dial back, take its by slowing down asset purchases, and that's not the same thing as slamming on the brakes. The analogy I would make is it's just lifting your foot a little bit off the accelerator, because we'll still be buying something for a while. And over time, maybe next year, we'll take our foot off the accelerator so much that we won't be buying anything, in the asset markets. There's no fixed date for that. What the Fed has said is those decisions will be made in response to economic developments, the progress we make towards our dual goals of, apple pie, full employment, and a Prius in your garage, right? Price stability. So that's the asset purchase part. We expect to dial back over time. Well, looking further ahead, the time will eventually come where the Fed will raise short-term rates again, and to what we call a more normal stance. So last December 2012, the Fed introduced a new form of forward guidance that explicitly tied the timing of what we call liftoff or exit from the zero interest rate bound to economic events. Instead of saying, we're going to keep the interest rates at zero until June 2015, that language was replaced with reference to numeric thresholds. And the language, and I'll quote, is that the Fed said that it, quote, currently anticipates that this exceptionally low range, basically zero, for the federal funds rate will be appropriate at least as long as the unemployment rate remains above 6.5%. So there's a magic number, 6.5%, what the Fed said in its language. Now, again, this makes it complicated, and even though, and I'll acknowledge the Fed's trying to be transparent, be clear, but at the same time, it's inevitable that some people are going to be confused, and maybe justifiably. So there's this magic number, 6.5%, the Fed said it's going to use in its deliberations as to when we're going to raise interest rates. But then at the same time, the Fed says, this is a threshold, it's a guidepost, it's not a trigger. A trigger means when you hit that, rate, then the Fed's going to raise rates. Really what the Fed's trying to say is we're paying attention on unemployment rate, labor markets, and it's when we cross this number, 6.5%, that's where we're going to really start heating up our discussion as to when we're going to raise rates. It may happen then, it may happen a couple months later. And in fact, there's a bunch of reports that came out of the staff at the Federal Reserve that were discussed in the press talking about lowering that threshold number of 6.5% to say 6%, 5.5%. Okay? But the point I want to make is the Fed has intentions to raise rates. It's just that there's no clear calendar date. It depends on events and the Fed's interpretation of events. Obviously, the more unemployment falls, the more jobs are added, the closer will be the time in which the Fed will raise rates. In our own projections at San Francisco, we expect the unemployment rate to fall below 6.5% early in 2015. So we don't currently expect that it's going to be appropriate to raise rates before then, but it may be even later. It takes till later in 2015 when we raise rates. So, in conclusion, and I really mean in conclusion. I always love it when a person says in conclusion and they have like 16 more paragraphs of points to make. So that's where we were. That's what I've tried to cover. Where we are and where we're headed. And I've also tried to cover why the Federal Reserve has done what it's been doing, why we've pursued monetary policy that we have. So I hope I've addressed some of your questions, or raised questions that you didn't know you had, about monetary policy and what the Fed's intentions are. And I'm happy to answer any specific questions you may have. But first I want to thank everyone for listening.
This morning, Janet Yellen was speaking or testifying before the Senate Banking Committee as President Obama's new nomination to be your big boss. I understand you work with her, know her fairly well, and maybe you have some insights as to whether this means anything for policy, what her style might be like, a little personal insight.
Okay. Well, Janet Yellen, you used to be the president of the Federal Reserve Bank of San Francisco. Before she took the current job she has now as vice chair of the Board of Governors. She was president from, I think, 2004 till about 3 years ago. I knew her before then when she was a professor at Berkeley. So yes, knew her sort of in various capacities, sort of in the academic community, and worked for her for a number of years. And no one can be, speaking personally, happier on her nomination for the position. You know, if you've followed the press, there was two major candidates, Larry Summers, somebody I know less well but have a high respect for, and Janet, to take on this really important job. So first I'll say I have the highest respect for her ability to do the job, for her knowledge as an economist, and also for people who work with her. She's always been a very smart person, and I've always thought she was the best person for the job, and I'm glad she got it. Now, what is she up against? Is she going to change anything? I kind of think whoever's in the seat there, and you have to understand the structure of the Federal Reserve. There's a board of governors, 7 people sitting more or less full-time in Washington. There are some empty seats right now. President Obama's going to nominate some people. Then there are 12 Federal Reserve districts. So that's 12 plus 7, 19 people meet regularly at these FOMC meetings 8 times a year, Federal Open Market Committee. Now it's complicated than that because the 12 presidents of districts don't all get to vote. There's a rotation formula. Effectively, only 5 out of the 7 get to vote. Anyway, but they all meet regularly. And the chairman of the board is currently, Ben Bernanke, sort of the first among equals. Controls the staff, but everyone gets to vote, that's on the board according to their conscience. But you still have to sort of show the lead in terms of this is what you prefer, and people try not to, try to support, their leader. Bernanke has operated very effectively. I mean, maybe actually achieving even more consensus than his predecessor, Greenspan. At least it's more transparent about the differences of views there are, and there are differences of views, about some of the issues I just talked about. When should the Fed dial back on asset purchases, whatever? So it's still a delicate process if you're the chairman, and I have the greatest faith that Janet will be able to do that. Will interest rates will the path interest rates be different? I don't think it'll be much different, give or take a couple of months than, if Bernanke would have continued or if Larry Summers would have been in the job. Everyone still faces the same challenge, monitoring where the economy is, how healthy we are, and when is the economy strong enough that it can continue on its own feet, so to speak, without having this extra stimulus from monetary policy. So I look forward for her to having an easy confirmation process and to be confirmed. Yes?
I have two questions. Number one, if I'm going to purchase something, I usually have to see if I've got enough money in my bank in order to purchase it. At what point does the Federal Reserve run out of money to do these the equity purchases? Second of all, when you look at the dot-com bubble and then you look at the housing bubble, there is a counterintuitive thing happening right now, and it looks like we are deep into an equity bubble. Every time the Fed says that they're going to keep things the way that they are, the stock market goes up, and every time they start hinting that they're going to do anything differently, the stock market goes down. You'd think it would be the other way around, that cut back on monetary policy would be something that the stock market would enjoy, but at some point, are the governors going to say, gee, maybe we're going down the wrong road? I was talking to Kelly earlier, and I said Einstein's famous statement, the sign of insanity is doing the same thing over and over again, expecting different results. At what point does the Fed say, we've been down this road, it's not getting us the results that we want, and we need to just cut back on the monetary policy, we need to stop buying all of the equity, and basically go through the thing?
Okay, two very good questions. First question, essentially, how big can the Fed blow up its balance sheet, right? As I said, have been involved in these large-scale asset purchases. We've bought up, I guess, trillions of Treasury bill securities, mortgage-backed securities. Before the crisis, the asset side of the budget was, roughly $1 trillion, and now it's $4 trillion, so that's $3 trillion extra. And how do we pay for it? Well, the simplest way to think about it is this is modern times, we Xerox the money, all right? We create the credit, all right? Now, that sounds, we've got anybody in the basic economics class, well, doesn't that sound kind of risky? Fed's just creating money. The problem is we're in unusual times. Because the credit the Fed's creating, so it buys these assets, gives people credit, which they put in their bank. The hope is the bank will then loan it out, and then starts this multiplier effect. For various reasons, the plumbing of the financial system is not working the way it was before. The banks, in large part, are just holding it as excess reserves on the balance sheet of the Federal Reserve. Now, eventually, the world will change, where banks, they are making loans now, they'll lend even more, and that's where this concern that what happens if they take all this extra credit the Fed's created, you start lending it all out, and you have a, in the short run, finite amount of goods to be able to spend money on, won't that be inflationary? Well, that's where the Fed is very aware of that potential problem and is thought very carefully about how to, when the water sort of flows the other direction, how does it moderate the rate at which the credit gets loaned? And we have these tools called excess reserve rates, interest rate on reserves. So the Fed has a tool which right now, if a bank holds extra reserves at the Federal Reserve, it gets an interest rate. Just, well, I don't know if I get an interest rate, I put money in the bank. My girls, my kids, you try to teach them to save, and they have their little jobs, and they put the money in the bank, and they get their bank statement, they get 14 cents of interest. And so the lessons of seeing the interest rate return on savings is a little bit lost on them. But they understand that you don't just go out and spend everything, at least in their case, because mommy and daddy can buy those things for them. So when banks start lending out the credit too rapidly, what the Fed will plan to do, it'll raise the interest rate on reserves. It'll kind of create this cost-benefit decision by banks. What's my return to lending it out versus my return to keeping it on the Fed's balance sheet? So right now, to summarize, the Fed has ramped up its balance sheet. Effectively, there's a limit because of the risk you undertake, that what happens if all that money you created suddenly gets thrown at goods, can the Fed have the tools to kind of dampen the demand for goods that would otherwise lead to inflation? The other concern is when you're buying up all these assets, how do you affect the functioning of those markets? Are they too thin? If the Fed owns all the mortgage-backed securities being issued, somebody who wants to issue mortgages or whatever, is the Fed the only buyer in town? Does that affect things? And that's things that the Fed looks at in terms of the costs and benefits of its actions. Your second question is, the way I interpret it is, in pursuing monetary policy like the economy, are we not creating another bubble in the stock market, right? Well, it's always hard to identify bubbles, before they occur. I mean, same thing with the housing market. There's way standards of comparison. What's quote unquote normal price of houses? You compare house to rental rates. Same thing with stock market. What's the earnings price ratios? So we're aware that it's gotten higher. It is a channel through which the Fed is expecting its policies to work. I mentioned interest rates being low as one channel. It makes the cost of loans cheaper, but people feeling wealthier is another channel, right? You'll go out and I have more money in the bank. So right now, the benefits of that effect of monetary policy through stock markets is perceived to be more important, be very important, and we don't see the risks of a bubble yet in stock markets. Now, to have that said, stock prices have been going up even the last couple of days. I mean, it's kind of amazing where they're going. But if the rates were to fall, I don't think the Fed would kind of step in to offset that. So we understand what's happening in stock markets, partly a response to monetary policy, people's expectations for the future of the economy. And those goes up and down depending upon what their perception of what's happening in Washington, Obamacare, whatnot. And we'll just see how the stock market proceeds.
One quick question.
Okay.
Last one, real quick, please.
Yeah, my question is that actually it's an observation more than anything. You mentioned that the unemployment rate is not a trigger; it's but a guidepost. And it seems to me that the market will provide the trigger, because as soon as they expect you to reach your guidepost, they're not going to wait for you to decide what to do. The market is going to do it. So I think that the statement that it's not a trigger is misleading. I think that when you put out there what your unemployment rate is, the market will anticipate that, and there will be a trigger regardless of what you do.
I agree that once you put markers out there, you may have your own perception about what you're trying to communicate. Somebody else, the market may react differently. Now, the most recent example of disconnect between the intentions of policymakers and the market was in September. Now there, it was not about specific unemployment rate. I don't know how deep anybody's following. That was about the beginning of tapering. And Chairman Bernanke had made a statement in June this past year in his press conference that he holds not after every FOMC meeting. There's 8 of those, maybe 4 of those he has a press conference to kind of amplify and go into more detail to questions the press raises. And he talked about trying to convey the consensus of what members of the FOMC felt about when tapering should start and when it should end. And the original language was asset purchases would continue, this is vague, as long as labor markets continue to improve. Again, something tied to labor market, but there hadn't been any language about a particular rate. In June, he had said 7%. That's when we begin to think about tapering. We might end in June of middle of 2014. A lot of the markets took that as well. The markets were improving. The labor markets were improving. We hadn't hit 7% yet because it's only 7 points, but they're improving. They for sure that the Fed was going to announce tapering, and that's why in June, after that press conference, in July, rates rose. Because it seems like they connected the statement about tapering to raising interest rates, which is not what his intent was to talk about. And then the Fed spent the summer trying to talk the markets down by saying, no, we're not planning to lift rates any sooner. And having said that, people still expected in the September meeting for the Fed, because labor market's improved enough. Because I said basic jobs have been growing 200,000, a month. But it's in the eyes of the beholder how much is enough. So the Fed in September decided not to start tapering, to start cutting back its asset purchases. And some of the market were surprised or not. So it's inevitable that in that case, the markets told the Fed something, but then the Fed told the markets back something. And that leads to some volatility in the markets, which we don't feel is good, but occasionally, the Fed want to make it clear that if we would have followed what the market said, we would have started tapering and sort of, in September, but we didn't. And now it's open as to when the Fed's going to, make that decision. It might be December, it might be March. So it's an interesting interplay between the markets and the policymakers.
Do we have time for just one more question?
No time, sorry.
You can ask me afterwards.
Dr. Glick will be here. But please give Dr. Reuven Glick a courageous